Well, Reserve Bank Governor Glen Stevens has been on his feet tonight with a speech called The Long Run, and he had something to say about retirees as investors who are in for the long run. Roger Montgomery from Montgomery Investment Management is with me in the studio. And now,
Hi,
Roger,
Ticky.
can I start by quoting a little bit from that speech? It's quite interesting. He says, this is the governor, says, can the corporate sector realistically promise growing dividends over a long period? He says, not without being prepared to take the risk on investment in new products and markets. Now, how much of that risk an older shareholder base will allow boards and management of listed entities to take is an interesting and important question, he says.
Well, yeah, that's almost a cop-out, because the big issue is that companies that focus on dividends to shareholders without focusing on earnings growth, BHP being an example of a company that talked only recently about starting a progressive dividend and more recently have said, well, we're going to back away from it.
Yes.
You can't do that. You can't promise increasing dividends unless you're increasing earnings. The issue is that if you increase your payout ratio, you need to increase your return on equity of your existing capital base in order to support higher dividends. And that's very difficult for any business to do, particularly in a competitive environment. So shareholders need to understand, particularly baby boomers who are retiring and are in pension phase, they need to actually appreciate that, believe it or not, their after-tax returns will be higher if they allow companies that can generate high returns on retained profits to retain those profits rather than pay out the dividends. Even when you take the franking into account, they're better off on an after-tax basis.
And the other extreme is if companies are under pressure to deliver higher dividends and end up having to pay them out of either debts or retained earnings or everything in the long run.
Well, that's just not sustainable. It's not absolutely unsustainable. And so Glen Stevens could have gone a little bit further if he wanted to, although he had a lot to say, but he could have gone further and actually pointed out that arithmetically, provided a company can generate an attractive rate of return on its equity, then shareholders will end up receiving that return on equity as their internal rate of return if you assume that there's no change in the PE ratio.
It's interesting that he's saying here the interesting question will be, well, will older shareholders actually allow this lowering of dividend in a way, he's saying.
Well, what are directors trying to protect by maintaining dividends? They're trying to protect the share price. And that's all they're trying to do. They're worried that the shareholders will sell out and the share price will go down.
But there's Jack Nasser there with BHP. He's almost driving this idea now, saying, look, we may not be able to deliver the higher dividend because the company's balance sheet comes first. I mean, it's interesting that they slumped today, I think below $20 again.
Let me give you the famous US example. There's a company in the US called Berkshire Hathaway, run by Warren Buffett. In 1967, he paid a 10-cent dividend and wrote a letter to shareholders saying, this is the last dividend you're going to receive. I'm going to keep the money because I'll get a better return on it. For the next 50 years, he generated admittedly a 21% return on incremental capital, and the shares went from something of the order of $80 a share in 1967 to now about $200,000 a share. So if a retiree wants income, they could sell a share, and if they want to have a particularly good year, they could sell 2 shares.
Yes.
You know, that's the tension that management will attract the shareholders that they attract with the menu that they offer.
Yep.
If they keep changing the menu, it's a problem for the restaurant.
Berkshire Hathaway, of course, is your pin-up example. But look, should we just?
Well, there are other companies in Australia that have done very similar things. You know, you can indulge me for a minute. Company M2 Telecommunications in Australia. In 2005, if you put $100,000 with that company, they managed to retain about 40% of their earnings and generated between a 20 and 30% return on their equity. 10 years later, that $100,000 is now worth about $3 million, and more importantly, the $3,000 of dividend that it was producing in 2005 is now about $100,000. So that's much better than Telstra, which was paying out 100% of its earnings as a dividend. Hasn't grown at all.
All right, Roger Montgomery, thank you very much for joining us there.
Thanks, Ticky.